And this is where we get to the problem, because there's one key piece of data, and it's not inflation data, that is making it more and more likely that the Fed is going to have to increase interest rates. It's becoming more and more clear that central banks all over the world are not done bringing the pain, especially as recent minutes from the Federal Reserve Bank in the US indicate that not all the governors were on board with the most recent pause. And as more and more of those governors start to take the stage and make speeches in their local economies, it is becoming more and more clear that many of them believe that the rate hikes are not quite complete. In fact, there's some debate as to whether or not the June pause is actually going to be a pause. And this isn't just a problem in the US. In Canada, now 50% of economists are now predicting that a rate hike in June is not only coming, but is going to be necessary as inflation continues to rise, especially due to housing. So it's becoming clear that the prospects of rate cuts in the fall are becoming less and less likely. And quite frankly, that the job of bringing inflation back down is not over yet. And in this video, I'm going to discuss exactly how we got here. I'm going to talk about the current situation and potentially what it means for the future. And I'm going to do it in a way that translates it from economist into layperson so that it's easy to understand. Not that all of you armchair economists out there can't understand it, but I'm going to try to make it as simple as possible and talk about the realities of what could happen in the future. And a lot of this is very much dependent on jobs. But before I do, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit the subscribe button and turn on notifications so you never miss a video on some really important stuff that everybody should be paying attention to right now. So let's talk first and foremost about how we got here and then talk about the problem that we're facing. So in the US, since March of 2022, interest rates have gone up by a total of 5%, from 0.25% to 5.25%. And in Canada, in the same duration of time, interest rates have gone up from 0.25% to 4.25%. Now, granted, the Bank of Canada stopped increasing their rates significantly sooner than the Federal Reserve in the US, taking the position that they needed to pause to see what was happening, and it's becoming more and more clear that inflation is definitely flattening out, but it hasn't started to make that turn to come back down yet. And what that could be indicating is that in both countries, more rate increases are needed. And as of right now, you're starting to see the predictions for rate cuts in the fall start to float away, except for with all the realtors and the mortgage brokers out there. But economists in general are starting to see that the light at the end of the tunnel isn't necessarily as close as they expected. And as the Federal Reserve in the US released their minutes for the last meeting, it's becoming more and more clear that it wasn't unanimous that June was going to be the point where they paused. Now, it seems likely that there's going to be a compromise amongst all of the governors, and there will be maybe a pause, but it might be more of a skip than a pause, because a lot of the central bank governors in the US seem to be very much of the opinion that more needs to be done, including Jerome Powell. And it isn't just the Fed governors that are having this opinion. Many economists are also expressing that same opinion. In fact, in the US, markets are pricing in a 63% chance that they are going to pause. Now, that means that there's a 37% chance that they will. So the odds are very much at this point 50-50 or very close to 50-50. And this is where we get to the problem, because there's one key piece of data, and it's not inflation data, that is making it more and more likely that the Fed is going to have to increase interest rates. And this is true for both south and north of the border. And you have to remember, from an economic standpoint, Canada is kind of like the 51st state. So everything that we talk about with respect to the US has a major impact on the economy in Canada. And the big problem is the jobs data. And this keeps coming up over and over and over again. The US Federal Reserve may be forced to defy market expectations by raising interest rates aggressively again later this year if sticky inflation and tight labor markets persist, according to Danielle Antonucci, or however you would say her name, the chief economist and macro strategist at Quintet Private Bank. Now, I don't know who this economist is, I don't know what bank that is, but I can tell you that this is very much a conversation that's being had with economists all over the world right now. It's that we have this situation where inflation is high, and we've also got this tight labor market. And tight labor markets present a problem in times of high inflation, because if the markets are tight and people continue to have jobs, well, that makes the job of getting inflation numbers to come back down even harder. Because what typically happens in an economy when you raise interest rates is you start to see companies scale back their production. When companies scale back their production, they scale back jobs. That leads many people to become unemployed. And when there's a small shift in unemployment, there tends to be a big shift in unemployment. And that shift in unemployment is typically what reduces demand significantly. And of course, from an economics 101 standpoint, with respect to inflation, there's supply, there's demand. If you can impact either, then you can affect pricing. And traditionally, the tool that affects pricing from an inflation standpoint the most is when you reduce demand by reducing employment. Okay, so I just want to pop back in here and create a quick note on supply and demand. Because, well, supply and demand is a basic concept. In the context of what we're talking about right now with respect to inflation and interest rates, it's actually really important with respect to what is happening in the economy and how those higher interest rates are going to affect demand. So this supply and demand chart is one of the first things that you see when you start economics in university. And basically the gist of it is there's two ways to affect a price. You can either change the amount of supply or you can change the amount of demand. So let's start with the supply side of things, because if you increase supply, that means that there will be more product available than people want to buy. And as a result, in order for those products to get sold, retailers will put them on sale. This is exactly what's happening at Home Depot right now, as they realize that they've got far too much supply in their goods and subsequently are creating sales on pretty much everything across the board. Meaning at Home Depot, pretty much everything is getting lower in price. And this includes everything from lumber to tools, which if you remember from the beginning of the pandemic, got extremely expensive really quick. Now, the opposite is true. If you reduce the amount of supply, something that there's not a lot of tends to hold higher value. Which again, when there wasn't many semiconductors being made at the beginning of the pandemic, well, guess what? Those got more expensive because there wasn't enough of them to go around. And it's arguable that a lot of the reason we have so much inflation is because a lot of goods were in short supply over the last couple of years. But the other piece of that was that there was so much demand because people, for the most part, got significantly wealthier during the pandemic as they spent less money and had lower costs on pretty much everything, which created higher demand. And when you have more demand, that means that prices will go up because there's not enough goods to meet that demand. And vice versa, if you have less demand, then things have to go on sale because there's not enough buyers. But in the context of this inflation conversation and this jobs conversation, increasing interest rates means most people have a little bit less money in order to spend. And most of the time in a normal high inflation environment, having just a little bit less money to spend creates less demand, and less demand ultimately equals lower prices. But when inflation gets as high as it's gotten in the last year, well, then you might have to do a little bit more. And you might have to make it so that some people have very little money to spend by creating a scenario where they don't have jobs. And that's why this balance between interest rates and unemployment is so important, because the way that inflation gets back to 2% quickly is if a small amount of people feels a significant amount of pain, because a small amount of people feeling a significant amount of financial pain does the job significantly faster than a large amount of people feeling a small amount of pain. And that's the balance that central banks are trying to find at this moment, is how do we decrease demand while limiting the damage when it comes to employment. But even with higher interest rates, we're seeing the job market remain tight, and people still therefore have the jobs that they need in order to make their payments, which is why we're seeing delinquency on things like credit cards and loans and the like, but we aren't seeing people default on things like car loans or mortgages. And the last payment that people miss is the one that keeps a roof over their head or provides them transportation. And it's typically not until people can't make their payments anymore by virtue of the fact that they don't have a job that the economy starts to turn and inflation starts to come down. And that's where we start to see the real estate market get soft, we see housing prices come down, we see car values come down, and everything tends to come down in price or stay stable because the amount of disposable income available to some consumers has virtually been eliminated. And that ultimately reduces demand because those people can't afford to have demand for anything. So this is where central banks find themselves in between a rock and a hard place. Because if they get this just right, they can increase interest rates just enough so that they don't create massive amounts of unemployment. But it's a very fine balance. And if you don't get it right, if you don't increase interest rates enough, then you risk losing control of inflation. But if you increase them just a little bit too much, well, unemployment isn't something that rises gradually. It's something that hits the broad economy quickly. And basically, when one company starts laying people off, almost all of them start laying people off. So unemployment goes from virtually 0 to 7 to 8% pretty much overnight. So that's the problem central banks are facing. It's, do we keep going or do we stop and hope that we've done enough? And the consequences of hoping that they've done enough and being wrong are significantly worse than the consequences of raising interest rates a little bit too much and having a lot of unemployment. Because the unfortunate thing about not doing enough is then you have to do more and you end up in the same situation anyways albeit at significantly higher interest rates and in a significantly more painful recession. So I don't envy the seat that central bankers sit in right now. They have a tough job. They've had a difficult job from day one when they thought inflation was transitory, and then a boat got stuck in the Suez Canal, and China basically had a zero COVID policy that led to a lot of supply shortages that led to significant amounts of inflation. And then you, of course, have all the money printing, but now it's getting even harder for them to get this right. And my guess is that they're going to err on the side of increasing interest rates more than they are of waiting and seeing what happens, which means that the Federal Reserve in the US and the Bank of Canada are definitely not done bringing the pain. So make sure you spend wisely, have a budget, and make sure you check out these videos for more information on how you can keep yourself safe if and when the economy gets worse.